Treasury One's weekly market review. And now, before we get to last week's diplomatic spat, which led to the panic in the markets, there were a few other events to take note of. Releases over in the US, most notably the weekly jobless claims and the Senior Loan Office Opinion Survey for Q1 continue to bear the markings of a tighter monetary environment. And while inflation ticked down slightly in April, the data remains far from reassuring, with core inflation slowing marginally from 5.6 to 5.5% year-on-year. Hope for a booming Chinese recovery is seemingly losing steam. When we look at April's trade data and inflation both out last week, it's evident the local demand still lacks oomph to support China's post-lockdown rebound. The CPI came in at 0.1% year-on-year. It's the lowest it has been since Feb 2021, with a contraction in PPI of 3.6% year-on-year, again indicating that domestic demand has not yet rekindled upstream sectors. Now, we do, however, expect inflation to pick up in coming months, but it's unlikely that it will get out of hand, and that leaves some space for policy support. And in the UK, the Bank of England continued its fight against inflation with a 25 basis point hike announced last week, as was anticipated. With inflation remaining sticky, though, the central bank was hesitant to announce that it has reached the end of the hike cycle, and in fact, one more hike has already been priced in by the markets. In international politics, there was a lot of focus on the Turkish elections last week, dubbed the most important elections of 2023. Current President Tayyip Erdogan's 20-year-long hold on Turkey could be in jeopardy. He came up short in Sunday's polls, failing to reach the 50% threshold for an outright majority. Erdogan is now expected to square off with his main opposition in a second round of elections scheduled for the 28th of May. Now, this all reflects a deeply polarized electorate, and the political uncertainty may rattle markets amid an already struggling Turkish economy. With all that has been happening in South Africa, it was easy to miss March's mining and manufacturing production data published on Thursday. Both sets of data, while not great, still performed better than expected. Mining contracted by 2.6% year-on-year against an expectation of a contraction of 7.6%. And South African manufacturing production saw a less severe contraction in March, with a reading of negative 1.1% year-on-year compared to a sharper contraction of 5.6% in February. The data will add some positive contributions to Q1 GDP numbers. And boy, do we need some positivity at the moment after last week's diplomatic rollercoaster. The rand tasted new highs following an accusation by the US ambassador that South Africa provided Russia with arms or ammunition during midnight operations on a sanctioned Russian ship, which mysteriously docked at Simonstown Naval Base in December. The ambassador also accused the ruling ANC of a hostile stance against the US. Now, I'm not going to recap the entire political drama that followed, but it should be noted that following US Secretary of State Antony Blinken's reaffirmation this past weekend of the strong ties between America and South Africa, markets seem to calm somewhat, with the rand staging a bit of a recovery. President Ramaphosa's calls to both Putin and Zelensky over the matter likely all created a calmer narrative. There are three things we can take away from this. One is that the continued negative sentiments towards South Africa on the back of the energy crisis, the grey listing, fiscal mismanagement, that all made the currency susceptible to an extreme reaction by the markets. And it's difficult to pinpoint if there will be another catalyst for a sell-off like the one we saw last week, or what it even might look like. But in the absence of any state reform, this almost extreme volatility is likely to remain the case for the foreseeable future, which could scare off investors. And secondly, last week's panic will bolster arguments for tighter monetary conditions in an attempt to protect the value of the rand. Now, we expect the SARB to up rates next week by 50 basis points, with more hikes expected going forward. And lastly, and perhaps this is more of a warning shot to the state, that although we operate at the far end of Africa more often than not in the dark, what we say and the company we keep matters, and the international players are taking note. That being said, given the growing Russian influence in Africa, the US won't make a hasty move which could send a diplomatic friend running to Moscow. This was likely a strategically timed and planned diplomatic maneuver to reach a specific US goal in the greater geopolitical scheme of things. And barring a complete misstep from our government or a bombshell revelation relating to the sanctioned ship, this threat is expected to unwind in coming weeks with the AGOA trade agreement intact. Looking to the week ahead, the EU will release its Q1 GDP figures on Tuesday, with April CPI data to follow on Wednesday. Now, we're expecting an expansion of 1.3%, and if realized, it will mean the bloc narrowly missed a technical recession. Inflation is expected to come in at 7%, marginally up from 6.9%, as it remains sticky, and this will then feed into further interest rate hike expectations, which in turn may add to a possible recession in the second half of 2023. Out in the US this week is the advanced retail sales for April. Tuesday's data may reflect an uptick of 0.7%, but we don't see this rebound to be sustainable. Furthermore, we're also expecting a drop in US existing home sales in April. The numbers will be released on Thursday, along with April's leading indicators. And all this data is expected to reflect the highest interest rate environment, with the signs of an impending recession in the US expected to intensify. Just on a final note, before the US came out swinging last week, ETM Analytics Director and Head of Research George Glenos and myself had a chat about the concept of de-dollarization and whether actual signs exist that the world may be moving in that direction. Now, Treasury One has shared the conversation on their Spotify account, so please have a listen. That's in the week that was and the one to come for the markets.